This is Justin Pulitzer. This is my weekend review video for Sunday, August 9th, 2015. Gonna jump right in. As usual, a good amount to cover. I'm gonna start off with the chart on the dollar because the commodities and the dollar and the interest rates have really, in my opinion, have been what's been driving the market. And you can see the dollar here had made some highs and then started to make some lower highs and lower lows, and was in a bit of a down channel here, but it subsequently broke out, held the retest, and has been not yet making, I wouldn't say, isn't really challenging the highs yet, but it is starting to make a series of higher lows and now starting to make some higher highs, and it's kind of just chugging around underneath the primary trend line, the primary down channel line. And I would say that this kind of consolidation pattern here bodes well for a move still higher. If it doesn't, obviously there's going to be a pretty steep collapse, but this to me, the way it's just kind of consolidating here, has a lot of risk for a move still higher. That has probably been what's weighing a lot on crude, this dollar strength. You could see crude rallied back up. I had said that if it got below this 54.24, it was going to see 50. If it broke 50, we would see these 45s-ish here on the primary trend. And it broke there, and now we're getting close to retesting the low down here at around 42.41. I would expect there to be some type of a bounce, at least some type of price memory here, just since this has been so steep. But if the dollar does spike, this is going to weigh on crude. I think what's also been weighing on crude is the prospects for an Iran deal. You could see Senator Schumer came out against it, but oil still went down, so that tells me that the Republicans probably don't have enough votes, to override the veto, and that the Iran deal likely is going to go through. Whether or not you think it's good for the country or not is irrelevant. The price is what is important here, and it seems like we're going to, at the very minimum, get close to or very close to this low, and then either bounce or have some type of a breakdown with a flush. Believe it or not, there could be another $10 down. I don't know if that's going to be sustainable in crude. That would take you back to like the 2009 low. It seems to me that production is starting to get cut. You already heard in the Exxon Mobil and Chevron conference calls that the, as you can see, I have a lot of alerts on here for Exxon. It's a stock I'm highly interested in. It's got a lot of relative weakness. It's been breaking down. However, if there is some type of a flush down here close to the 61.8 fib, around 74.59, I would say that that would be a great right or right out trade for some type of a bounce back up. I do think at some point it's going to fill the gap back up to these 83s. I just don't know what the order of operations are going to be if it kind of just chugs around here and then kind of bangs back up. Like you can see here, it sort of had a false breakdown and then rallied. But they have been cutting their capex. The price of crude dropping is affecting them. There's going to be a large round of layoffs, so I would expect that these companies at some point are going to be a buy. It's just a matter of from what level. They are very much, they see keeping their dividends as religion, so at some point the yield will matter. Let's move on. The Dow Jones has been showing the most relative weakness. You can see there's been some lower highs, some lower lows. We stopped on a up regression channel. It's not really a full up. It's sort of an up line, but there was a violation a couple of months ago. It's not really that important to go back, but this here caught it. We filled this gap here, and I guess we sort of held, although we are below the 200-day moving average. You can see it was actually resistance. So this is really key here with the Dow. This actually probably would have looked a lot weaker on Friday, but it was kind of saved Zach Morris style, saved by the bell by American Express. They had a big $1 billion capital investment and this big reversal bar, you can see, that took out an entire range and basically came up and filled the gap. This is sort of what I'm looking to eventually happen in Exxon, but Now it's sort of show me. We'll see what happens. There could be some room still higher, back to the old trend line, which has been kind of resistance on the move up. That would also be a 200-day moving average. If there's some type of a pullback here, I would say 50% or so of the bar, it would be okay. If it gets more than that, then it is a little bit more troubling. Yeah, so that's American Express. The other Dow stock I would say that's kind of been cray is this Disney, and they had run up really a lot, and it just pulled back. A lot of this was on the weak ESPN information, although you can see here we have now firmly broken the uptrend line from the gap. I'm looking for a move. I was actually looking for a right or right out trade here right off the 200-day. It stopped just ahead of it. Of course, that's what this market loves to do, stopping before the true support, and then the rallies aren't as strong and they're not as playable. But I would say that somewhere between this 61.8, which is the 102, and maybe if we can get down to the gap fill here, which is also the 78.6, somewhere between the 94s and the 96s, somewhere in there, 95s, 94s, that would be a really great right or right out trade, in my opinion. There could also be some type of an overshoot to the trend line, but we'll deal with that when we get there. A lot of it is the character in which we get there. Sharp and fast is the way I like it. We'll see if that plays out. However, I want to just point out that this type of a move, this is a really gigantic move for a stock like Disney. Disney doesn't really move like that. You can see, I guess on earnings here there was a gap, but it, on the whole, it's sort of not like that volatile of a stock, and this is starting to trade like biotech. When stocks like Disney trade like biotech, you better pay some attention. VIX, we did make a new low here. It reversed fairly quickly because there is always some type of a intrinsic value for volatility. We had a fairly sharp reversal, failed at the moving averages, but you can look. The stochastics are really bombed out. They're starting to turn. This could be a turning point in volatility to come back up and kind of re-challenge into these 17 areas. If that happens, I would be interested. Between 17s and 20s, I would be interested in start selling premium again, either puts or calls. And I love to start doing put ratios, particularly that in the S&P 500. Speaking of the S&P 500, the spiders came down, didn't have the same type of relative strength, sort of relative weakness that we have in the Dow. We have been making higher lows, but also lower highs. We held roughly where we needed to, a slight violation of the 200-day, stopped for the most part on my unofficial, kind of official though, regression line that I drew in. I'm usually pretty good at doing that. We bounced up pretty nicely. We held the 200, we held the 61.8. And we closed ever so slightly above my cautionary level of 207.84. We closed right above at 207.95. So we rejected sort of at the body here, but we kind of stopped there. But I would say that this was a little bit of a hold. If there's a gap up on Monday, maybe there is a move back higher to retest somewhere closer to the 50. If there's a gap down, we'll have to see how this body here holds. I've been sort of very cautious on the market. I haven't loved this sideways chop and these 100% retracements in this tight range. I guess, it's worked as far as, buying the range low and selling the range high, but as far as like position trading in stocks, it hasn't really done very much in that form, so I guess we'll just trade the market we have rather than the one we want. I keep talking about smaller position size, shorter time frames, and looking for smaller swings. That is what's been working. That's what will continue to work until it doesn't. Once you get into a trending market, you can start either shorting rallies or buying dips again. As of now, it's just playing the extremes of the range. If this does wind up breaking, obviously we have a reference low around here of 206. I don't know if that's going to be the holding. I would think we would retest these 204s fairly quickly. There is a gap fill similar to that of the Dow and a primary trend line or a channel line around this 201.90-ish area by the time it would get down there. if we start showing some weakness and we start getting some VIX pop, and you can start getting $3 spreads in the with 1/2 ratios, or if we even get up higher, you can maybe get it cute with 1.1/3s. But I would be looking to play a 1/2 SPY put ratio to get down here and play for that type of a move. You could even play for one down here, or if you want to play, like, for example, be long like the 205s or the 206s and then like short the 202s. That to me would be a great trade, and I will be looking to put that on. You kind of have to do those into weakness though, because you need the IV to expand so you can get the spreads to expand, if that makes some sense. IWM, I've been a little cautionary on. We did violate the this 120.97. We rallied back up. I cautioned last week's video that we got right back up into the resistance, and of course we subsequently rolled over. We did hold on trend. We did hold the 119.39. We haven't yet seen the 117.37, where I am going to be Johnny on the spot for a right or right out type of trade in that area, likely by buying some call spreads or something just for some type of a bounce back up. But we'll have to see where the IV is. If the IV is high, then I'll probably just do it with stock, or maybe sell some puts, some very near dated puts, maybe down in the 115s or somewhere down near this trend area. But I do think that this is starting to look a little bit troublesome, considering we are in a down channel with lower highs and lower lows. This is kind of roughly an equal low, but it is a little bit lower. So we're going to have to see how this plays out. If we lose here, we're going to see the 117s, I think, fairly quickly. If we rally back up, maybe we come back into range a little bit and to retest some of these hammers up around the 123s. Qs. So Qs have been kind of, you live by Apple, you die by Apple in the Qs. I guess Google as well. You can see we've been making a little bit of lower highs, a little bit of lower lows, although we have held the 50. We did close relatively strong here. We did hold the 109.42 area with a 2-tick violation. Just got to show you these levels that I put up here really aren't BS. They really work. If there is some type of a break here early next week, I think that will come down fairly quickly to test mid-range here to fill the gap down to the 107s. I would think that that's probably a good spot to cover if you're short and bearish. And I would be looking to maybe do some type of right or right out trade here for a long. I don't know that we get the full 100% retracement, but as you see, there's a lot of reference areas in here that could act as support that you can do right or right out trades against. If we come back up above the 111.16, then I say it's kind of on like Donkey Kong for a potential a run back higher to the highs. We'll see how that plays out. This was just a kind of a really big move. I would say that this is really just more consolidation. The pullback is still kind of considered quote-unquote healthy. If you start taking out these lows here, then I'm going to start getting, there's going to be a very different tone and a very different conversation that we're going to have. But let's not cross that bridge just yet. I don't think that it's worth discussing. Apple, absolute weakness. I had said that this 122, this really 121.99, 122 area was really key. It was lost, and look at what happened. Absolute pandemonium. I've been looking for a move down to this 109.03 to 110-ish area. That's the gap fill from this whole run. We didn't quite get there. Very annoying. Decided to bounce and consolidate. That's okay. We are starting to get a little bit late into the stochastic, so any sharper move down lower, I would say, is an area to play for buy the dip. If we do wind up rallying first, somewhere between this 119.75 and this 122 area is likely going to be some resistance. Maybe it presses a little higher into 123s. But I do think up here into this upper distribution, you can see where the volume distribution is separated. Once you start getting up into here, there is going to be a lot of people who had been long up in here who want to get their money back. And they will be motivated sellers. I will be happy to be a short. Probably, I'll kind of start peppering in around the 120, Maybe I would do it around 125. That's sort of like been some more staunch resistance, but we'll see. I just want to see how the stock, how it feels, if it feels heavy, if it feels euphoric, also what the overall market is doing. But I do believe that Apple has got a bit of a tough road to hoe here, so to speak. I do think at some point this gap will fill. I just don't know that it's not going to go lower first. I've been saying that I would love a run down to the 101s for the primary trend, roughly around this 100. Oops, what happened here? Roughly around this 100.72. That was sort of the old high before Apple had the big pullback, the 30% pullback or what have you. That coincides beautifully around here with this channel. So a big sharp move down here would be great on some type of an IV spike. Look for Apple to sell puts when the IV is somewhere between 35 and 42. That has been great. When it starts getting below 25, 26, it's cheap and that you don't want to be a premium seller. You want to be a premium buyer. Google. Broke down, sort of has a bit of a failed check back, but really just consolidating. I mean, it ran $50, it ran another $100, and now it's just pulling back into some of these fibs. Not surprising, just looks like some consolidation to me. If there is some type of a break here, maybe you want to play for a bit of it, more of a move down for the gap fill for this entire move. This, what is this here? The 601, somewhere between 601s and like 615. I would be looking to play by the dip here, maybe sell some out of the money puts against like a 50-day moving average or, even these highs. The 582s, once you start getting down into these areas, the 615s and the 601s, 605s, whatever around that area, I'd be looking to sell these 580 something puts, particularly if it's a sharp move and the IV starts getting jacked. Facebook doing what it really should, just consolidating and chugging. However, this bar here is very disturbing. It's very reminiscent of this bar and the subsequent sell-off that had happened. I think put ratios will work here if you want to play it against the 50-day moving average. So it'd be like long 90s, short 88s. Near dated, please. If this is too long, it's gonna go against you because the delta will become positive. Sorry, I know it's a little wonky and we're talking some more advanced option terms. I do believe 88s here are a right out area. I would love for it to come down here and then to like sell like 85s or 83s. This was somewhere between 85 and 83, maybe even 84. I think this area is going to have a lot of price memory and would be a great right out buy if there is continued weakness. If we just kind of chug here and start getting more into this body, then I would say the old all-time highs are in play. The stochastics here are rolling over a little bit, which is a little bit concerning. Sorry, I just wanted to bring up my screen. It was starting to get a little dark. We are starting to roll over here a little bit, and I am a little bit concerned that there could be some type of a play like this where there's just a move down and a lot of chop and consolidation. That would actually be very healthy for the stock to work off some of this like excess run up that it had on Google. But sideways is good. I like to kind of wait for some consolidation and then move. If we do consolidate here, we've done it for a while, and then we take the highs, then I think it's a momentum chase to the long side, and it should continue to run. The opposite of that is this piece of this Twitter that is in the pullback mode and is below the old reference low of the 29.51. Anything below there to me is vulnerable. The IPO was like 26s, so that could be a right out area if you want. But the stock is still like $20 billion or something, and they don't have growth. That's a lot of money. I know a lot of people keep talking about it as a acquisition target, but when fundamentals are declining, it's very hard to play for that. Their earnings were good, no doubt. They did well, but their growth is the problem. They're not getting users. People don't really understand how to use the service. I've said for a while, I think they need to become more like Instagram. That, I think, would be a really great selling point for Twitter. Back to macro for one sec with regard to TLT. I want to talk a little Fed. I should have got this out of the way earlier, but unfortunately didn't. The TLT here is now broken the down channel, and it is now clearly making higher highs, higher lows. into some resistance here of the 200-day moving average. I do think that there is some room to still push somewhere into the 126s and maybe even the 127s. If there is some continued strength, I do think there'll be a lot of recession talk there. You know, with all of this talking head chatter of all these quote-unquote experts that think the Fed is going to raise interest rates in September, you know, rates are going lower. It's clear, and we've broken out here. We've broken a down channel. There may be some rollover. We'll see. But TLT is looking a little, that's my lower for longer thesis that has been playing out. Eventually, that should help stocks, and we'll see how that goes. But in the near term, there might be a little bit more turbulence. You can see the backside of this old up channel is roughly around here, so that coincides with the gap fill. I would be looking for a nice right or right out short in that area if we can get it for some type of a quick rollover play. Oops. FXI, China. It's coming back down. It's just kind of hovering. It hasn't re-challenged these lows. These lows, again, had stopped just before the 61.8. I had actually played this by shorting some puts and took them off into the move here. We're coming back down. I'm not as quick to touch it. I'm kind of waiting to see how this resolves. What I would love to see this do for me to want to get long is to see this low hold and then they take these highs and then, of course, start the pattern that I love to see of higher lows and higher highs. Until you see that, you know, it's a little bit troubling. Maybe there's a move back up at some point to some of these fibs. We'll see how that goes. BABA acting like the piece of you-know-what that it is. Trying to put in a higher low, but kind of rolling over. Honestly, the best case scenario would be to do what we did here, have some type of a false breakdown. This is at risk, in my opinion, of coming to a, you know, doing what Twitter did and breaking down maybe and getting down to the 60H, which was the IPO level. We'll have to see how that goes. I do think at some point, and I keep saying this, and it hasn't really, it did play out here to some extent, but it didn't play out fully, that they are going to try and get it back up to 100 at some point. If you can stomach the volatility, if you don't mind putting on some protection, or you want to play at defined risk, you know, some cheap call spreads might work out for that type of a play, and you just have to be fine if you lose it. BIDU kind of just shopping around here. Going to start coming into some resistance somewhere between the 180s and 186s. Could be a decent right or right out short type of a play. Maybe it wants to kind of come up and fill the gap. I don't know, but you know, China hasn't been acting so well. This could also easily roll over again. I'm sort of just a no touch with these Chinese stocks. Amazon, a little bit of rollover. It closed below this low here. Looking a little bit suspect. I would be cautious with Amazon if long. There is some risk. You know, we are kind of rolling over a little bit with regard to the stochastics. We'll have to see how that winds up playing out. I would be an interested buyer maybe on the gap fill for some type of a quick bounce play, or maybe off of the 50-day, which looks like it has been holding for a while. If you want to try some put ratios, maybe that's your terminating strike at the lower end of the range. FireEye, they reported their earnings were really good, but they have a CFO that is leaving. That's always very concerning to Wall Street. Everyone starts thinking accounting fraud or that there's something going on in the company. There's a unique opportunity here if you're bullish for a right or right out. You can see you have kind of a Harami hammer here. If you want to play against this 42.66 to 42.27 for right or right out, that's fine. If these break short, probably targeting down to the 200-day moving average, and potentially even lower into the mid-30s where I would be an interested buyer. Put ratios here would work out well if there is some type of spike in IV. Palo Alto has me very cautious on the entire sector. You can see this 50-day moving average had been rock solid support. We came down into this. Somebody had asked me on the stream if this was the buy. I said I didn't like how we were getting there since you had this big engulfing bar. How you get there is important. Look how many days, this little chop it took to get down there, these little choppy days, and this was just this big engulfing bar that took out like an entire week's worth of trade. It turned out to be the right move. It came even still lower. You have a bit of a hammer here. If you're long, if you want to play Palo Alto long, above this high of day might be a play, you know, to like kind of check back to where this breakdown was. But if you lose this hammer here, I would say that there's risk considerably lower. It is now doing something that it hasn't in a while. It is making lower highs and lower lows. Be very cautious. Everyone knows that this area is a really good has the news cycle, the wind at its back. All you do is hear about hacking. But I will tell you, I had been long FireEye. I just want to go back to FireEye here for a sec. I had been long into this run, and I remember the kind of feeling any day now it could kind of roll over. This was just like this begrudging. It was kind of felt very forced. I don't really know how to describe it. I mean, if you drive stick shift in a car, you know what I mean by a forced feeling. But it has wound up coming down. We are making lower highs and lower lows. Like I said, we discussed that. I don't want to go over it too much more. Netflix, these highs are starting to feel, this thing keeps on getting upgrades with analysts chasing still higher price targets. If you want to be short, just be short against these highs, anything above there, and there could be still further move. If you look at this on a longer term chart, it is really getting parabolic. You want to see this thing go sideways and consolidate a little if you're bullish. I would say if you're a long, you don't want to see this really get below these 117s. Somewhere between this 116.59 and 117.88. This should be kind of like your floor. If you start getting below there, there's some gap fill risk, maybe even down to the 50-day at 100. Seems like a fairly reasonable expectation. Price line I had been discussing being, I thought that this was going to be a long for earnings. It wound up having this really huge gap, but they sold the bejesus out of it. And why was that? It was back up to a reference high. There were a lot of reference, I guess, people who had been long and they wanted to get their money back, or just people who were playing, long in here. And, the stock had run into it and they just sold it off a bit. It'll probably wind up coming back down and filling the gap. If it does that, you might want to play some type of a put ratio, like long here and then short puts still down here. Sorry for that alarm that's going off in the background. I hope you can't hear it, but if you do, my apologies. We're almost done. TASR. I've been looking for this for a long trade for a while. You did have a bit of a head and shoulders breakdown here, a really big reversal bar here, and it just kind of cascaded down. The reason for this was they reported their earnings. Their earnings were good, but they had pulled forward some sales that closed in this quarter that were supposed to be in the next quarter. So I guess it was technically a guidance lower, but they still have the money. I think this is a way overdone reaction. With all that's going on in Ferguson and Baltimore, I think that this stock has got a long-term thesis. We filled the gap here. We are now right up against trend. Stochastics are bombed out. I think you can play long against these 23s. I had discussed that on the stream. I played it a little long. This would be a right or right out trade if it breaks. Then we're going to start looking for something somewhere between 20.20 and 21.37, which would be the 61.8 fib and also these reference lows. I think that would be you could do a put ratio for a move down here if you want to get long here and just want to get it a little bit discounted, or if you want to just wait and kind of play it that way. So it would be long again. If you aren't in it here, you want to see over the high a day here for some type of a move back up. But I do think longer term that this is a great thesis. Tesla, we'll end on Tesla. Just take a look. It ran into the number. It got back into some reference levels. I had discussed the 65s being the key. Even after they reported, it was still hanging up there. It wound up coming back down lower. I still think longer term there is going to be some type of a move up higher to try these Fibonacci extensions up in the 300s. On a squeeze, this is still the story of Tesla is still a heavily shorted stock that's poorly distributed with consolidated insider ownership. It's hovering around these this 100-day moving average. I would be looking to buy it somewhere down a little bit lower, somewhere in the 220s for a right or right out play, or if it got down there to sell like 205 puts, I think that area is fairly solid support. You can see there's a lot of price memory down there, so it would be like coming down a little lower and then selling those puts for some type of a bounce play. Anyhow, that's my story. I'm sticking to it. If you're not following me, my Twitter handle is @JustinPulitzer. Be sure to follow me. If you like this video, hit the like button and be sure to hit the subscribe button. It's right below here. I'm going to put a link to the Periscope live Q&A I did in the description down below. So just click on that and you can hear it. You could and see it really. I'm also going to put a link to a new article I wrote. It's about the lower for longer thesis that was published on realmoney.com. So click the link in the description and you'll be able to read that. Anyway, let's have a good week and cheers.